It's early 2026. Believe it or not, we are experiencing through one of the weirdest economic cycles in history. And most bank managers are telling you the best way to combat inflation is to save money. Actually, they are all lying. Let's look at a set of data. The bank gives you 3% for a year, or maybe 15 to 20% if you lock it away for 5. They say inflation is slow, but anyone paying bills knows it's easily over 10%. If your interest isn't beating 10%, your money is just melting away. Honestly, bankers are full of it. They want cash on their books so they can pay the market and lend it out. They are just exploiting the knowledge gap to squeeze every cent out of you. So, as ordinary people, what can we do? Is there any better investment options with low risk we can trust? In today's video, I'm gonna tell you there are better investments options than stocks, precious metals, and bonds the next 5 years of certainty. That is real estate. Hi guys, I'm Stevens. If you're here to level up your investment game and sharpen your finance mindset, you've come to the right place. We don't just watch tickers here, we find the why behind the moves. The more you learn, the more you earn. Let's dive into the best low-risk strategy for the next 3 to 5 years. Lately, everything from gold and silver to copper and stocks has been pumping, except for crypto. All these are green on your screen. Yeah, I know a lot of you are still hesitant. You are keeping your money in the bank or even just put them in your pocket due to consideration of safe. Inflation is hitting your wallet hard, eating into your savings. But please spend 10 minutes watching this video patiently. You might change your mind. If you can't seize the date with these investment opportunities, you might regret missing a potential 5-year window. Soaring prices, continuous layoffs, and company bankruptcies, and a growing number of pessimistic economic reports have emerged. Why? Because the world feels unstable. We are faced with a lot of uncertainties. We've got geopolitical tensions, talk of a global slowdown, and that constant fear of the next black swan event. That one surprise disaster that wipes everyone out. You want stability. You want something you can touch. You want low risk. But you are tired of your bank manager patting you on the head and give you only 2 to 3% interest, while inflation eats 10% of your purchasing power. If you've got a low risk tolerance but you are tired of being left behind, we need to talk about alternatives. Real estate stands out as a low-risk, tangible asset that offers a powerful inflation hedge and stable passive income. Even if you can't tell quickly why building wealth through financial leverage and long-term appreciation. Back in the day, everyone saw new real estate as a safe haven. Developed market already blew up with massive bubbles. So don't expect big returns today. What if I told you that while the West is stagnating, we can focus on the East, especially southeastern of Asia? This isn't just about buying a house down the street. It's about fighting the moats and safety nets in the global market. Here is a staggering data. Ho Chi Minh City's real estate market grew by 33% in 2025. What you need to do is simply look for undervalued assets in emerging market. Patiently wait for their prices to rise or consider renting them out to obtain passive income growth. I remember talking to a friend back in 2023. He was terrified by the stock and crypto market. He ended up buying a small rental unit in an emerging district. While his friends were sweating over daily crypto candlesticks pattern, he was collecting rent and watching the rent value appreciate by double digits. He didn't need to be a pro trader. He just needed a physical asset in a growth zone. I think this case can be a reference for you. Before we talk about where to buy, we have to talk about who you are. For beginners, I divide strategies into 3 times based on your expected returns over the next 3 years. 1. The stability first year. This tier matches a return range from 20% to 50%. If you want to sleep like a baby, you need a mix of physical and liquid assets. The mix: 30% in silver and copper plus 70% in an S&P 500 index fund. Why? You get a safety of the world's 500 largest companies with a kicker from commodities that hedge against inflation. By the way, about copper, since industrial demand is sky high in 2026, if you want to learn more about it, feel free to search my previous video. 2. The prioritizing growth tier. This tier is for those who want to build real wealth, not just preserve it. It matches a return range from 50% to 200%. The mix: a combination of growth stocks and emerging market real estate. Why? This is where you find the 30% annual growth rates. You are betting on urban development and rising middle classes in places like Southeast Asia. For this part, I must clarify one thing. Many people consider emerging markets to be representative of Asia, but that's not entirely true. In fact, we can also focus on Africa. There are some worldwide investment opportunities on this continent as well. 3. The aggressive moonshot tier. This tier is much aggressive since they expect the return at least 200%. The mix: crypto and high volatility tech. The strategy: you don't trade this daily. You wait for the 3 to 5 major dips we get every year. You buy when everyone is crying on social media, and you can sell when the people around you want to ask you how to buy Bitcoin. In a word, buy when they panic, sell when the world all hype. If you think the options above are still too digital, you have to look at the global real estate map, but you have to look outside your backyard. According to authoritative data from Knight Frank and CBRE, the prime global cities list is shifting. The winners aren't London or New York anymore. The entry price is too high and the taxes are too aggressive. Let's see the top potential real estate markets from 2026. Ho Chi Minh City, Vietnam; Dubai, UAE; Bangkok, Thailand; Mumbai, India; Tokyo, Japan; Saudi Arabia, Mexico; Warsaw, Poland; Athens, Greece; Istanbul, Turkey. Let's zero in on Vietnam. Why did Ho Chi Minh City rank the first globally with a 33% increase in residential prices? It's not just a bubble. It's built on 3 pillars: geopolitics, economics, and supply. The China Plus One strategy. Because of global geopolitics tensions, major manufacturers like Apple, Samsung, and Intel have moved their supply chains into Vietnam. This isn't a temporary trend, it's a permanent shift. When factories move in, when managers move in, luxury housing demand skyrockets. 2. The supply crunch. The CBRE Vietnam 2025 outlook highlighted a massive supply shortage. The government has tightened regulations on new developments, meaning the houses already built are becoming incredibly rare and valuable. 3. Business environment. In 2026, Vietnam has made it significantly easier for foreign capital to flow in, compared to the red type offshore or the price to perfection market of Singapore. HCMC offers a lower entry point with a much higher ceiling. When we look at the 2025 or 2026 data, here's how HCMC stacks up against the safe bets. Short and Tokyo. Very safe, very stable, but low growth. You are buying for preservation, not wealth creation. Dubai, high growth but very sensitive to oil prices and regional stability. It's flashy but can be volatile. Singapore, the ultimate safety net, but the entry prices is astronomical. It's a rich person's game. Ho Chi Minh City, it hits the Goldilocks rule. It reached the return 33%. The security, strong manufacturing base, and the ease of assets. If you are a beginner, don't just dump all your savings into one condo in Vietnam. That's not what we do here. The 2026 smart plate is fractionalization or focus entry. Diversity within the city. Look at District 2 or District 9 in HCMC. These are the new cities where infrastructure like the metro lines are finishing. Think 5 years, not 5 months. Real estate is a slow asset. It protects you from your own impulses to panic sell. My personal rule, in real estate, the price increase you see on the news is just the surface. The real mode is the business environment. If a city is building subways, attracting tech giants, and has a young population, the property price has to go up. It's simple physics. Recap. Your 2026 beginner cheat sheet. Stop hiding in cash. The bank is a slow leak for your wealth. Identify your tier. Are you looking for 30% stability or 200% growth? Match your assets to your goal. Go where the growth is. Don't be afraid of emerging markets. Look at the Knight Frank Prime Index. If a city is growing at 33%, pay attention. The Vietnam mode. Ho Chi Minh City is currently the global leader because of supply shortages and the manufacturing shift. It is the safety net with the rocket engine. Think long term. Use real estate to anchor your portfolio so you can take smart risks in other areas like crypto or stocks. The world is changing fast and the old rules of just saving money are not suitable. But that doesn't mean you have to gamble. It means you have to be more strategic. Alright, I will continue following these global trends for you so you can stay ahead of the curve. I hope you found this breakdown helpful. If you enjoyed this video, please give it a like and subscribe so you don't miss any of our deep dives into the 2026 economy. Thank you so much for watching. Catch you in the next one.